speaker is one of my favorite topics, behavioral finance. And today's speaker, Daniel Crosby, is educated at Brigham Young and Emory universities, a psychologist and behavioral finance expert, an asset manager who applies the study of market psychology to everything from financial product design to security selection. Dr. Crosby recently co-authored a New York Times best-selling book, which is on your chair, Personal Benchmark, Integrating Behavioral Finance and Investment Management. Daniel is the creator of a composite measure of equity valuation and market sentiment, and is at the forefront of behavioralizing finance. His ideas have appeared in the Huffington Post and Risk Management magazine, as well as monthly comments for Wealth Management and Investment News. Daniel was named one of the 12 thinkers to watch by Monster.com and a financial blogger you should be reading by AARP. He's named the top 40 under 40 by Investment News. When he's not consulting around market psychology, Daniel involves independent films and fanatically following the St. Louis Cardinals. Well, we all have our issues. He also spends time with his wife and 2 children. Please give a warm Atlanta Society welcome to Daniel Crosby.
It's great to be here, everyone. My wife and I moved back to Atlanta. I did a postdoc at Emory. We moved back to Atlanta last October from the hub of art and civilization that we know as Northern Alabama. So it's great to be back in Atlanta. It's the city that I love. We could have lived anywhere we wanted to, and I chose Atlanta because Atlanta to me combines the best of a sophisticated large city with the gentility and kindness of the South. So it's great to be back. One of the things that I love about Atlanta is that there's so many smart people here doing important work. And among some of the important work being done here in Atlanta is that we are the world's center for epidemiological research. So I'm going to, however unappetizingly, begin my remarks today with talking about Guinea worms. And I had the good sense not to include any pictures here in deference to the fact that you would be eating. So Guinea worms are a huge problem, or were historically a huge problem in Africa. They spread like crazy, millions of people were infected, and the problem was so vast that this illness, that this infection was actually crippling economies and wasn't allowing nations to rise because we couldn't cure these Guinea worms. They're incredibly reproductively adept. A female guinea worm has 3 million eggs, and this is how they spread. You get guinea worms, so then the only way that you can find relief from guinea worm infections is by cooling the flaming sensation, typically in your feet, in the local water supply. So let's say I get infected, I run to the local watering hole, I dip my feet in there, and then the process starts all over again. But some smart Atlantans right here from the Carter Center and from the CDC did something that has never been done before. They took a disease, they took an illness or an ailment like guinea worms, and they cured it for all intents and purposes. We went from 3.5 million cases in the mid-'80s to just over 100 cases today, and they cured a disease for which there is no cure. There's still no cure for guinea worms. We still, if someone gets it, there's nothing we can do about it. But the way that they did it was by helping educate and train the villagers around a couple of good behaviors. There were 2 things that they looked for when these CDC researchers went out. They said, what is the hallmark of the villages that are unaffected versus the ones that are having guinea worm outbreaks? They looked at these villages and said there's 2 things that are in common across the villages that are doing well. The first is a willingness to speak up, basically a willingness to rat on your neighbor, to say, hey, you know, Mrs. Jones has guinea worms, don't let her near the water supply. So the villagers would work together to rat out their neighbors, to keep them from going near the water supply, and then the problem was shut down. So this is the only time in human history that we have single-handedly eradicated a disease for which there is frankly no cure, no medicine, no treatment. We still haven't figured out the magic pill, but we've managed to stem the tide of the guinea worm. Now, something similar is afoot in the financial services world, right? And the cancer or the worm that's eating us is bad behavior. Many of you are probably familiar with the Dalbar study that you see on the far left. Many of you may not be familiar with the other 5 or 6 studies you see up here. But there are about 6 or 7 credible estimates of what we call the behavior gap. And I prefer to just sort of average them. I find the Dalbar study to be a little bit histrionic, find some of the others to sort of underestimate it. So if we average the difference, or the money that's lost, the returns that are lost each year by investors down to their bad behavior, we arrive at a figure of about 2.25%, 225 basis points a year in investment underperformance is attributable to bad behavior. So everyone in this room knows the power of 2.25% over an investment lifetime, but just for kicks, let's say someone my age with a 30-year time horizon underperforms a conservative 70-30 portfolio that's getting 8% a year for 30 years, it's going to just about halve my terminal wealth. Right? I'm going to have half as much money at the end because I make bad decisions. Now, there are a couple of ways that we've gone after this, and most of the research to date has been around how do we get typically retail investors, how do we get the end client to make better decisions with her money. And one of the things that we've found pretty consistently is that knowing about behavioral finance, knowing that we're fallible, knowing that we make these mistakes is simply not enough. It takes someone else sitting there with us, holding our hand, guiding us through, which is why research from a number of sources sort of speaks to the value of a financial advisor. Are there any advisors in the room? I know there's 1 or 2. Okay. So here's for the advisors. Think about this. Take this to your clients. The research is unequivocal that the greatest value that an advisor adds is behavior management. Vanguard did a study on this and found that people who work with an advisor outperform those who don't by 3% a year net of fees. They broke it down further, though, and said, what accounts for this 3%, which is very lumpy, by the way, and concentrated, the benefit of working with an advisor is concentrated in times of market volatility. And they said, what is the breakdown of the different things an advisor does during his day and how do they add value? And they found 150 basis points of that 300 basis point outperformance was directly attributable to hand-holding. So nothing else came close. Nothing else an advisor does is as powerful as serving as a behavioral coach. Aon Hewitt found something similar. They found that the average effect of working with an advisor was 1.86% outperformance per year, but that it was 2.92% per year during times of volatility. And then finally, Morningstar did a study in which they talked about gamma, which is their word for helping people make better decisions, that they attributed a 2% per year increase to folks who had guidance with respect to gamma. So that's the self-management piece, and that's what behavioral finance usually touches on. But that's about half of what I do, but I feel like it's the less interesting half. And so today we're going to talk about something that doesn't get discussed a whole lot, which is how do we apply behavioral finance to asset management? How do we actually apply the findings of behavioral finance to the selecting of securities, to the way that we manage money? So just like the Guinea Worms, I undertook a project to do something that I drew from the words of Leo Tolstoy. Tolstoy, I'm sure you've heard, has his quote about all happy families are the same, but every miserable family is miserable in their own way, in effect, was what he said. So I found that all behaviorally adept, all the behaviorally sound portfolios have 5 things in common, even though there are limitless ways to make stupid decisions with your money. But they all sort of boil down to one of these 5. So I feel that if you can control these 5 facets of behavior, you're well on your way to managing behavioral risk, which is a prerequisite to generating the kind of returns we want. So here are the 5 ways. Now first, let me say that there are 177 ways that psychologists like myself have identified to get it wrong. There are 177 bad heuristics, mistakes that we make pretty routinely. But all 177 of these load onto one of these 5 that we're about to talk about. Okay? The first is ego. I want you to raise your hand if you have a worse than average sense of humor. I don't know, man. That Red Sox joke was good. Okay. So we're very reticent to admit our weaknesses. And I mean, sense of humor is one that there's not a whole lot of baggage around. I mean, we could get more personal if we were so inclined. And it would become harder and harder to admit it. Raise your hand if you are a worse than average money manager. Okay, right? Yeah, I didn't think so. I didn't think so. So one of the things that animates our bad decisions is a sense of ego. And if you're not depressed, you have what's called overconfidence. I mean, pretty much everyone that is not clinically depressed has what psychologists would classify as overconfidence, which is we think good things are bound to happen to us and bad things happen to other people. When you ask people to assess the likelihood of getting cancer, getting divorced, etc., even when they're shown the probabilities on the left-hand side, they dramatically underestimate it on the right-hand side. That's the purview of other people. That's not going to happen to me, right? We have this ego, we have this overconfidence, so we have to manage that. The second is emotion. Emotion colors risk perception. So I'll be vague here in an effort to remain appropriate, but some of the best research done on emotion coloring risk perception was done by a gentleman named Dan Ariely at Duke, who asked people about their sexual behavior. He asked them about sexual risk-taking, their preference for sort of strange sexual behaviors, and they answered much like you'd think they would, kind of vanilla, kind of safe. They know all the right answers. Well, then he messes with their emotions by showing them videos that put them in an amorous state of mind, shall we say, right? He then asks them to take the same quiz, and they are unrecognizable to themselves. It's a little bit like the Snickers commercials. When you're hungry, you're not yourself, right? When you are emotional, when you are feeling intense emotions, you are a stranger to yourself and your rules. You no longer operate by the same guidelines that you normally would. The next thing is we have bad information, or we fall prey to the idea that more information is always better. We'll talk about that in some detail later. The next, which is a big one, is mistakes of attention. The human mind is equipped to hold on to the lurid, the negative, and the strange, but to ignore probability. If I told you that a study came out this week that said there are now more deaths by an order of magnitude due to selfie taking than shark attacks, you might not believe me, but that is the case. More people die each year taking selfies than die from shark attacks. But yet, if you ask me after this presentation if I would like to take a selfie with you, I would oblige that. I would not go swim with sharks, right? This is just the way that things work. If it's lurid or strange or dramatic, we hang on to it. So we have to find a way around that. And then finally, there's conservation, which is the human tendency to want to maintain the status quo, to do as little as possible, and to dislike losses relative to similarly sized gains. So how do we manage these things? Well, I've tried to come up with four approaches that I implement in the way that I manage money, which is what I call the 4 C's of managing behavioral risk. And you could come up with your own. Really, I think it's about coming up with a system that suits you for managing those 5 pillars of behavioral risk. I'll just tell you how I do it. And so it's consistency, conviction, clarity, and courage is how I go about this. So the first, consistency, is very hard to hear. It's very hard to hear largely because we want to root for the indomitability of the human spirit. We want Rocky to beat Ivan Drago. We want Kasparov to beat Deep Blue, right? We never cheer for the machine. But I'm afraid to say that very often simple processes, systematic approaches, and simple rules outperform human discretion, even among a room of very smart CFAs. So the reason that this is the case is that fans of 90s rap will know that Snoop and Dr. Dre lied to you, because nobody is laid back when their mind is on their money and their money is on their mind. Nobody is laid back. In fact, we're so emotional about our money that we get stressed out when we think about money, and we actually, in times of duress, lose 13% of our IQ. So this is a very repeatable statistic, and some of your clients, frankly, don't have 13% to give, right? So we lose 13, not you, certainly not you, your clients. So we lose 13% of our smarts under duress. So even if we are the best educated, most well-read, most the thinking person's money manager, a lot of that is out the door when it matters most, unless we have systems and processes in place to check our bad behavior. People tend to systematically underguess how much environment impacts performance. We are all far more susceptible to the moment than we think we are. I want to show you just how different inputs impact the way that we make decisions. The City of London has found that by playing classical music on the tube, on the London Underground, they can reduce attacks and assaults on personnel dramatically, because we're not always as agentive as we think we are. We are impacted by what's in our surrounding. A more powerful example still is companies can actually manipulate your choice of alcohol. A study done recently found that a company that had a wine selection from all over the world could manipulate their supply of wine by the type of music they played. When they would play French music, 3/4 of people would gravitate towards the French wines, right? When they would play German Oompa music, a slight majority of people would buy beer and German alcohol. I'm a little out of my depth here. I'm Mormon. I have no idea what I'm talking here. So, and then a final example. Are there any Audi drivers? Anybody drive an Audi here? Okay. I'm gonna let your partners know about this study. So in a recent study on infidelity, it was found that Audi drivers are the most likely to cheat, you dirtbags, right? Audi drivers were the most likely to cheat. So this study found that 25% of men and 15% of women cheat on their first spouse. Okay, so in first marriages, about 1/4 of men and 15% of women cheat on their first spouse. I'm seeing some worried looks in the audience, by the way. And when they looked at what was the best determinant, you know, we would like to think that the thing that determines whether or not I'm going to cheat on my spouse is my morals, is my convictions. And I mean, of course, that is the case to some degree. But overwhelmingly, they found that the single best predictor of marital infidelity was whether anybody wanted to sleep with you in the first place. So they found that people with money, people with looks, people with nice cars cheated at a disproportionately high rate because people wanted to cheat with them, right? Whereas the people who weren't, it wasn't necessarily because they had lofty morals. Often it was because they didn't have an offer, okay? So again, which is why, incidentally, I have gained 25 pounds since being married 10 years ago out of a deep and abiding commitment to my wife, and to just make sure I have no options, right? So sheer opportunity is the single best predictor. Again, it's not what we think we know, it's very situational. So how does this apply to investing? Well, Joel Greenblatt, the famous systematic value investor, did a fascinating study. Many of you are probably familiar with his magic formula, which combines earnings yield with return on invested capital to generate 25 to 50 stock portfolios automatically, right? And it's had exceptional results. Just basically trying to do the simplest approximation of Warren Buffett-style investing. What Greenblatt found is that he offered these magic portfolios, as he calls them, to investors in two different ways. One way was that they could buy it straight from his firm, Gotham Capital. When they bought it straight from his firm with his top 25 picks, it returned 84% over a 3-year period. He also offered them discretion, where free of charge, you could and you still can, go to Magic Formula Investing and generate a list, the same list that he operates from, of the top 50 stocks, except then you could use your discretion to weed out, say, yeah, I don't want to buy this one. I heard some bad news about this one. I'm going to take this one out, right? In the condition where people were allowed to use discretion operating from a proven and, dare we say, magical formula, they still underperformed the benchmark. They had that much of a head start. They underperformed the S&P over that same 3-year period because they made all of the wrong decisions when they used their discretion, even when selecting from that limited universe. And he's not alone in finding that rules beat discretion. In fact, a meta-analysis of over 200 studies where PhD types were pitted against simple models, the model beats the expert beats or equals the expert 94% of the time, and outright beats the expert about half of the time. It's only about 6% of the time that the expert beats the rules with any consistency. So the takeaway here is this, is that rather than being a floor, our systematic approaches, our rules, tend to be a ceiling on our performance. The other thing that this allows us to do, of course, is that it allows us to pass on lower fees to our end investors. You know, if more folks were using rules-based approaches, using limited discretion, and relying primarily, at least, on systematic approaches, it becomes a lot more parsimonious and cheaper to construct these types of models. So Jim Simons, arguably the most successful hedge fund manager ever, and his 35% annualized returns, had this to say: "We slavishly follow the model." This is a guy who has won every mathematics medal there is, but he still has the humility to say, I can build a great model, but I don't necessarily know more than that model, as smart as I might be. And I think that's sound advice based on our tendency to want to manage that bad behavior. The second C that we're going to talk about is conviction. And in this, I'll just warn you that I'll probably anger every single person in the room by dumping on both traditional passive and traditional active approaches to asset management, because I think they don't account for our psychology in important ways. So when I talk about conviction, I mean diverse enough to be humble and to limit systematic risk, but convicted enough to be worthwhile and to pass on to our clients. So something that a lot of folks don't know about, but that's getting a lot of press right now, especially in Great Britain, is that many, nay, most active managers are passive in active clothing. It's expensive indexing, okay? A study done at Drexel found that 8% of ETFs are high conviction. You wouldn't expect a high number there, but that only 23% of mutual funds differed significantly from the benchmark that they seek to track. 23% of mutual funds are high conviction. More damning still is that it costs a lot of money to get a high conviction portfolio right now. It costs an average of 128 basis points if you want real active management. So we have to get away from this passive and active clothing. So to do this takes less than most people think. We've learned so much about diversification that a lot of times we fail to remember how quickly you can arrive at a diversified portfolio of stocks. Anywhere from 16 to 30 names gets you the lion's share of diversification against systematic risk, and it does so in a way that allows you to be different, provide real value, but it takes guts. Active management works. If you look at anything from the research on active share to the study set forth here in Dr. Tom Howard's book, he finds that the highest conviction picks of equity managers outperform the benchmark by 6% per year over the last 100 years. 6% a year, the top high conviction picks. We know what we're doing. We just dilute it to the point that it doesn't work anymore. We have to find that sweet spot between the ego of owning too few stocks and the timidity of owning everything, because we owe that to our clients. Passive approaches have a behavioral glitch as well that's not commonly discussed. The behavioral glitch present in passive approaches is that they tend to do exactly what you ought not to do, which is to concentrate in things that don't work. Market cap weighted passive approaches, of course, concentrate you in large stocks and expensive stocks, which are two of the worst performers over long periods of time. They also overweight the most bubbly assets, which is why you would have a significant tilt toward tech stocks in 2000 and a significant tilt toward financials before the last recession. We can do better than this. And I'm also scared because passive investing has become the thing to do. And from a behavioral standpoint, nothing is scarier to me than when something becomes the de facto right answer. It becomes crowded, and bad things come from the crowd in my world. The second thing that I think we owe it to our clients to understand is that there really isn't such thing as passive investing. I think a lot of people think passive indices are mined from the earth and come to us unspoiled just the way they are. But few people know that, for instance, S&P has a committee that is just as fallible as any of us are. And this committee selects the names that they want to add and take away each year. And they're susceptible to the same behavioral biases that any of us are. Which is why you see in 1995, 12% of the additions S&P made to the S&P 500 were tech names. But that by 2000, 41% of the new additions they made were speculative tech stocks, and they broke their own rules of their mandate to include stocks that weren't profitable. Stocks like AOL, womp womp. We know how that went, right? So the question is not if we are active, but how should we go about it, and how can we do it in a way that gives us real conviction? The third C is clarity, which is the paradoxical truth that complex dynamic systems like the stock market actually require rules that are simple to avoid overfitting. We need simplicity, not a ton of rules. So one reason that this is so draws on one of my favorite names for a psychological bias ever, which is homage to everyone's favorite furniture store in Midtown. So the IKEA Effect. So the IKEA Effect says that we are going to reduce our perception of the riskiness of something if we had a hand in deciding, making a decision about it. Just by virtue of us helping and bringing our brilliant mind to the table, the thing gets less risky. So the example here is this. They have the scenario that you see above. You're presented, the participants are asked to decide whether or not they would lend this person money. And they're told that the single best predictor of whether or not they'll get repaid is recent repayment, okay? So group A says this: you get a recent college grad with a good job, middle-class job, and the last 3 months they have not paid a $5,000 bill. Okay, so group A says 71% of them say, no, I will not loan this person money because I know that $5,000 in the last couple months is a risk factor, not going to do it. Group B receives the same profile, except they are told it's either $5,000 or $10,000 that they haven't paid. You can look into it. If you spend about half an hour researching it, you'll be able to decipher if it's 5,000 or 10,000. Now, of course, compare this to our first example. At very least, it's the same, and at most, it's twice as much. But in this group, only 24% of people deny this person alone because they think, by my very involvement in the process of researching this, what I know to be a risk factor has become less risky because I brought my brilliance to the table. By working harder, we get a worse result. Excessive information also leads to base rate neglect. You remember before that we attend to the phenomenal, the exceptional, the strange, the unusual. So listen to this description of Linda and decide which you think is the correct, more probable answer. Linda is 31 years old, single, outspoken, and very bright. She majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice and participated in anti-nuclear demonstrations. So this, I would actually like you to participate. This is not a rhetorical question. Based on this description, which is more likely? Is it A, Linda is a bank teller, or B, Linda is a bank teller who is active in the feminist movement? Who thinks it's A? Okay, who thinks it's B? Okay, it's A. Why is it A? Someone shout it out. Yeah, right. So the subset of feminist bank, so feminist bank tellers are a subset of the larger universe of bank tellers, right? But about a third of you, very bright people, thought it was B because you got sucked in. You got sucked in by that information that was salient but unimportant. Salient but unimportant information leads us down a bad path, and it's nowhere more present than in financial markets, where the media and others compete on clicks and drama and scare more than they compete on good information. Again and again, we find that less is more. We have a huge prison problem in our country that's being addressed, finally, in this election cycle. But one of the most robust findings about prison recidivism is this. The old approach was to convene a parole board of highly educated people, psychologists, guards, different people who know lots about life in prison and ostensibly know a lot about what should constitute the likelihood of going back to jail. So these expensive, time-intensive panels, their results came up with a 6% correlation between their findings and prison recidivism. Pitiful. They nearly quadrupled that by looking at 3 variables and doing away with the panels altogether. What did you do? How did you act in jail? And what was the third one? Yeah, number of prison rule violations, past convictions, and the nature of your offense. So if you did something horrible, you acted a fool in jail, you're not leaving, right? This is a better predictor than whether you give us a good sob story on the day of your hearing and act contrite, because this is what we're looking for. We're looking for contrition. Contrition doesn't matter, right? With just 3 simple variables, we can cut out the parole boards, we can cut out the stupid psychologists altogether, and just make 4 times better decisions. So I know you're saying, yeah, but what about finance? Because finance is different, because we need to do deep dives on everything, and we need to go put boots on the ground, and we need to have lunch with the CEO of Acme Corps and determine whether or not I like the cut of his jib, right? Is this the way that it works? There's no research to support that. There's, again, research to support that in many cases, more information is worse. More information is worse. So they'll do studies where they say you can have 1 piece of information, 5 pieces of information, or 30 pieces of information on a stock. And which do you think outperforms? It's 5, right? Because 1 piece of information is not enough, 30 is too many, and we tend to get sucked down the rabbit hole of attending to variables that are salient, they're sexy, they stand out, and they do not matter. And this is found with everything from stock picking to trying to predict who will win the college football championships. Hint, it's Alabama. All right. So this is why in my own approach, I try and take a less is more approach. I tried to look at what matters, what works, and I look at those things. So for each of the 5 things you see above, there's 2 handfuls of indicators that I look at. But I look at price. Is it attractive? Is it a value? Is it attractively priced? I look at profitability or properties, which is my shorthand for quality, because quality doesn't start with P, and I'm not going to ruin my 5P approach for stupid quality, right? Is there a moat? Is it a high-quality purchase? I look at pitfalls. Is there evidence of manipulation? Is there excessive leverage? Are these cooking the books? I look for those risk factors. I look at people. What are the insiders doing? How do they pay a dividend? Are they buying back their own shares? And then finally, I look at push, which is momentum. So I have a very simple, automated approach of buying a basket of 25 stocks that are cheap, that have a catalyst, and have honest people working there. And then I go hang out with my kids because I can't improve it by worrying about it further. The final one is perhaps the one that I get the most pushback on, and it's courageousness. I feel like we as an industry need to be more honest and more courageous with our clients. And I think that this takes two forms. The first is the vast majority of the time we need to induce our clients to do nothing, to stay the course. But I think on the other hand, we have to be equipped with metrics that say, yeah, it's time to freak out now. It's time to freak out now, or at least get a little bit defensive. So for me, courage means being fearful when others are greedy and greedy when others are fearful, but automating the process of knowing when we ought to do those things. Are there any soccer fans in here? Yeah, okay, good. Again, I'm kind of out of my depth here because I'm from Alabama, so I know about as much as you'd expect a guy from Alabama to know about soccer. But there was a great study done on soccer goalies in the Euro League. And the Euro League, they found this, that when there's a penalty kick, goalies have a dramatic tendency to do one of 2 things. 96% of the time, they dive dramatically to the right or dramatically to the left. They try and anticipate which side of the goal the kick is coming to, and they make a big show of, flinging their body, leaving it all on the pitch or whatever you call the soccer field, leaving it all behind, right? They don't want to leave anything behind. This doesn't work. This doesn't work. But they do it anyway, because in some countries you get killed if you let people score on you in the World Cup, right? So they do this anyway, even though the best thing that they can do is what? Stand still. About 1/3 of goals, the shots on goal are almost equally distributed, right, right, left, center. But dives go almost 100% to the right or left. If you just sit there, you're able to stop way more goals than if you're flinging your body at either side of the goal. And yet, what do goalies do? Still predictably, if you turn on ESPN, they throw themselves at one side of the goal or the other because of what we call action bias. They don't want to regret not having done enough. They don't want to stand there in the middle like their shrink told them to and then look like a doofus when it goes to the right. Okay? There's a lesson in this for investors because probabilistically, the market goes up 2/3 of the time, down 1/3 of the time, and over long periods of time, it goes up almost all the time, right? So this is why the studies by Barber and Odine and others find that activity is hazardous to your wealth. This is one of my favorite studies because it's one of the foundations upon which we build the very real truth that women tend to be better fund managers than men. Women outperform men pretty dramatically, and a lot of it has to do with patience. So I see some of you smiling. Go ladies. A lot of it has to do with patience. The worst traders of all, single men. Then it's single women. Then the best traders of all are married women, and then next is married men, right? So there's a settling effect to marriage, and there's also gender elements to it. But you see here, performance decreases monotonically with activity, which is a nerd way of saying, right, it goes down the more active you are, the less you get. Part of that's churning, part of that's fees, part of that's straight up underperformance. Usually we need to have the courage to do nothing. That's usually the right answer. One of my favorite studies ever done was done by Fidelity when they tried to do something not dissimilar to what the Guinea Worm researchers tried to do. They went to their clients, the retail clients who had the best performance, and they said, you know what we're going to do? We're going to drill down and see what are the common elements of exceptional equity performance among our retail investors. So they call up these folks, and do you know what the modal response was? The most frequent response was, oh my gosh, I forgot about that fund. I forgot about that account, right? So Fidelity found that their best performing clients were the ones who had forgotten that they were clients at all. And there's a real power in this. And again, I cannot emphasize this enough. Usually the thing to do is to stick with your plan. But there's also danger in complacency, and I think danger has been building up. I think risk has been building up in the equity markets over the last 6 or 7 years because of this sort of complacency. Because the fact is that we're actually getting a lot stupider. We're actually getting a lot more irrational as the years go by. The frequency and intensity of bubbles is increasing. And you see this here. If you look at sort of the trough to peak run-up of some famous bubbly assets, and I've got sort of their current price there on the right if they're still around, you see that information is not making us more efficient, as the efficient market hypothesis might have suggested, but in fact, information, the 24/7 news cycle, is actually making us more prone to some of the excesses that build up risk in the market. I also want to show this chart. You know, we have a habit in our industry of saying sort of lazily, I think, stay the course, do what you ought to, stick with your plan. But the fact is that over the last 100 years, these are 15 and 16-year increments that you see there where the market has given us no real return, or an even negative real return in some cases. And I think that we can do better for our clients. I think that we know a little bit more about when markets are frothy than we let on. And I think that that is our obligation to them, to keep them put most of the time, but when things become so disconnected, to help them get more defensive, or at very least, try and manage their expectations about what the future will bring. The fact is that every single developed country has had catastrophic nationwide loss of wealth at some time in the last 100 years. Huge, life-altering destruction of wealth, and we have to help our clients be on guard against that. We can't talk about it every day. It's not always there, like Zero Hedge and other websites would have you believe, but there are times when things get really, really scary. And so for my part, again, what this looks like to you is what it looks like to you. I'm trying to espouse a principle here, and then I'll tell you how I think about it personally. From my role as a value investor and as a behavioral finance guy, I think of it in a couple of ways. I think that risk builds up in the system as valuations become disconnected from their historical norms. So I get a little bit scared when valuations rise above about the 70th percentile, because then we're looking at the possibility of something pretty ugly. And for me, I think about that the way I think about this is the way I think about potential energy. If you remember back from your Physics 100 class or whatever, potential energy, maybe when you draw back a bow or position a ball at the top of a ramp, I feel like when the market becomes disconnected from its fundamentals, when it becomes very steeply valued by historical norms, that there becomes a greater potential energy for a crash. That when some catalyst does happen, we tend to fall harder and faster, and history has backed that up. So personally, I look for, when I start to get defensive, is when valuations creep above the 70th percentile, and then I start to see technical indicators of weakness like flagging sentiment. I mentioned earlier that I measure sentiment in my own way, and also momentum. So this has happened in my lifetime. This has happened 3 times. That these 3 things have happened. Excessively steep valuations, bad sentiment, bad momentum. This happened in September of '98, November of 2000, and last August. So I'm worried. I don't know how else to put it. So where are we? Momentum continues to be weak. Sentiment has fallen every month since last August by my measure. And valuations are still at the 79th percentile. I take three popular measures of valuation, combine them, average them out, and convert it to a percentile rank. And still, as of today, we're at the 79th percentile for historic valuations on the S&P. So to me, I get a little frustrated when I see folks on CNBC talking about stocks are on sale. It's a pretty crap sale. They're on sale relative to where they were a couple months ago, but it's still not a great sale. So I gave a talk to the CFA Society of Calgary last April, where I said at that time that my projection based on these things with 5-year projected forward returns of negative 1.5% a year. I can stand before you today and with great happiness report that now I'm guessing that we'll do positive 1.5% annualized for the next 5 years. So I remain pretty bearish, and I think that part of our opportunity and part of what we need to do as behavioral managers and and as managers of people's behavior is to be upfront with people about times when things really aren't that good. It's not always a great time. And I think that we destroy trust when we sell that way. So as I begin to wrap up, I just wanted to point out, again, bring it back to those 5 facets of behavioral risk. If you can manage these 5 things, you can do so much better than you're doing today. This is how I manage them, right? With these 4 C's, I try and check that each of these 5 facets are managed, but you can go your own way. How will you manage your ego? How will you manage emotion? How will you make sure that you're attending to only the best information? Some of you work in a world that looks very different than mine in managing domestic equity, so it's going to look different for you. But those 5 facets of behavioral risk remain very relevant for you. So as I close, the way that I think about it is this. The way that I think about rule-based behavioral investing, which is what I call what I do, I think about it as trying to be the house in Vegas instead of being the drunk dummy that's sitting at the blackjack table, right? So I want to relate a story that was related by Paul DePodesta, who used to work for the Dodgers and now I think works for the Padres or something. But anyway, a baseball guy, front office baseball guy, and a stats head. He talks about being in Vegas with his buddy, and his buddy is at the blackjack table, and his buddy is holding a 19. And his buddy's had a little bit too much to drink, and he said he wants to hit on 19. He wants to hit on 19. So DePodesta's like, dude, what are you doing? Like, you can't hit on 19. Don't be a fool, right? You can't hit on 19. And the guy goes, no, hit me. And so the dealer hits him, and he gets a 2. And so he turns to DePodesta and is like, in your face, I told you, right? To which I say, you can be right and still be a moron, right? You can be right and still be a moron. The way that I operate, the way that I manage money has everything to do with trying not to be a moron. It doesn't always work. It's not always right. But it's always right to try and come up with systematic ways to manage your behavior. So thank you so much for your time and attention. It's been a great pleasure. Kind of. So, I think it's discovering that happy middle place. And admittedly, I talked to him, he's working with derivatives. This is not anything I know anything about. It's going to look different for different people. But I think the principles apply. I think the principles of of being systematic, of being rules-based to try and avoid emotion and bad decisions. I think the principles of taking a research-based approach to what's signal and what's noise. I mean, like, sometimes I see what people are managing folks' money on, and I'm like, I don't know what the answer to the stock market is, but it's not the Baltic Dry Goods Index. You know what I mean? It's just like trying to figure out what matters the most and systematizing an approach that keeps you in that lane. So there's a right number of questions to ask. There's a right number of reports to read. There's a right number of factors. You have to discover what that is. But I think the basic principles of simplicity and systemization apply pretty broadly. So it's interesting you bring that study up, because I just finished another book. I hope you enjoy this book. There's a couple extra copies in the back if you want to bring one home to a client or whatever. So one of the things that I wrote about in my new book is just what you talked about, that professional money managers tend to have their highest cash concentrations at all of the wrong times. So it worries me that I'm so heavily in cash right now, and those other dummies are too, because they're usually wrong. So it worries me. I mean, that makes me question my own assumptions, frankly. In terms of what I look at with my sentiment measure, I had about 20. One of the things that I dislike about traditional sentiment measures is that a lot of times they ask people what they think, and people are dumb, and people don't have great access to why they do the things that they do. And so I only look at data, and I weight that data by the last 100 years of what has been important. So I started with 20 variables that loaded on to what I would call sentiment. I did a principal component analysis to see which ones worked. Only about 6 or 7 of them did. I then weight them by what they've, how historically predictive they've been of returns. And so by that measure, I'm pretty bearish. Okay. Yep. But yeah, that first thing you mentioned does make me wonder, because people usually get it wrong. I mean, usually when managers are at their highest cash positions is a sort of a contrarian signal. So I don't think that we'll get good returns until we've had very bad returns. I think there's no significant bullish case until we get smacked pretty hard. That's my own bias. Yeah.
Sorry, just to follow up on that. How do you call your bottom, or where do you
So I'll get back in at the very opposite. So when sentiment has begun to tick up, momentum's begun to tick up, and valuations are no longer frothy. So the exact opposite. Yep. Oh, sorry.
What valuation methods do you use?
3 different ones. Top secret. Says one high conviction value manager to another.
Do you invest globally? Emerging markets, for example, needs a separate one, or country bias?
So oh my gosh, why are you calling me on the carbon, man? Yeah, so there is a home country bias, and I'm part of that bias because frankly it's out of my circle of competence. I mean, I think this stuff would work, and I think the rest of the world is much more, or many parts of the world are much more attractive than we are right now. And in my, with my personal money, I'm diversified outside of the U.S. But for the way that I manage my own fund, I just don't know. I buy international index funds. Don't know what I'm doing there. Yeah.
What about sentiment, not cash?
So there's a problem when we get to periods like this for folks like me, is that all the traditional rules break down, and I mean you've just seen value get smashed for years in a row now. And there are some times like this, and that's part of why I like using this sort of behavioral overlay. When things get so disconnected, all the old rules are gone, and so yeah, I'm heavily in like lame, boring stuff like energy and airlines and just lame, boring stuff. But yeah, I'm systematically out of stuff like tech. But I still think you've got to be underweight stocks at a time like this if you're a value manager, because just all the rules break down and nothing works like it ought to. I mean, there's some very talented people getting torn up over the last 2 years. Yeah. Sure, there's no doubt, although 2 things. There's no doubt that you could do very much worse than doing nothing at all. I mean, that's one thing that I've tried to be pretty emphatic about. Another thing is, if you look at the universe of everybody, Yeah, I mean, people tend to get in and out at all the wrong times. And I published something on LinkedIn the other day where they've been calling a bubble, different news outlets have been calling a bubble for, since 2009, like loud and long and repeatedly. So I look at what I look at because it's worked historically. If you look at returns, real returns when the SMA or when the S&P is below its 200-day moving average, the average is 0. Is the one-year forward returns when we're below our 200-day average. But still, that gives you a lot of false positives. It would have gotten you out 11 times in the last, 37 years. Mine would have gotten you out 3 times in the last 37 years. So I try and look for every reason possible to stay invested. I think that is the hallmark of any kind of tactical approach, is it has to be very infrequent, because by probability, probabilistically, you're making a low probability choice there. So, yeah. Absolutely. And so I should say there are times, this is an imprecise distinction to make, but something like value or momentum, which has its roots in, I would say, psychological realities, right? I feel confident going back 100 years on looking at value and momentum. Something like valuations, if you look at something like a Schiller Cape or something like that, it's about doubled in the last 35 years because the quality and the type of business has changed. So I don't look at Schiller Cape, for instance, which is one of them. You tricked me. I don't look at Schiller Cape for the last 100 years because I think then you'd always be scared. But I do look at stuff that's more psychological, because my bias is that people don't change. Like, I think in 100 years from now, people are still going to update, underreact, overreact, update their priors too slowly, underestimate value stocks, et cetera. But for some things, I look at the last, say, 30 years when I feel like maybe the fundamentals have changed. So that, yeah, and I'll be the first to admit that's imprecise how I choose one over the other. Yep. Thank you.